ladies and gentlemen, and welcome to our class on pivot point trading and strategies. Today we're going to be discussing pivot points, how to find them, how to use them, what the differences are, and then how to incorporate them into your trading strategy and how you might want to use them to make entry points, exit points, stop loss points. We're going to be going through all about pivot points today. Now, do you know what a pivot is? Usually a pivot is a pin on which something turns, a key player or position, the important person in some situations upon or about which something rotates or oscillates. In sports, the pivot is an important handball player who oscillates in the attack zone. In trading, a pivot is an important price level. For day trading, traders try and mix different trading strategies and patterns. Traders popularly use various technical analysis tools, and one such technical analysis tool is the pivot point. Pivot point trading is prevalent in the equity and commodities market and is part of the major tools of technical analysis. A pivot point is an indicator developed by floor traders in the commodities markets to determine potential turning points, also known as pivots. Forex pivot points are calculated to determine levels in which the sentiment of the market could change from bullish to bearish. Cryptocurrency or currency traders see pivots as markers of support and resistance levels. Short-term traders will use pivot points to determine when market sentiment has gone from bullish to bearish or vice versa. If the market breaks this level to the upside, then the sentiment is said to have shifted to the positive. On the other hand, if price slips under this level, then sentiment is considered negative. Pivot point levels are price levels on the trading chart calculated based on the previous trading session's high, lows, and closing rates. Like everything, open, high, low, and close. They help decide the support and resistance levels for the current and next trading session, next candle, next time frame. Pivot point price levels can be used as support and resistance levels and help traders decide when to enter the market or exit the market. Short-term trading uses last day pivot points or the last, whatever time frame you're looking at, as insights to the overall market trend for that period. As the pivot points are calculated on the average of the previous trading session's data, it represents moderate, accurate, and updated predictions to the market. Pivot point trading is a trading strategy where traders use pivot point levels for entry positions and exit positions as important trading levels. Online traders use hourly, daily, and intraday pivot point levels. Weekly traders use weekly pivot points, etc. Using this kind of strategy, traders trade assets respecting current volatility. Like other technical analysis tools, there are various ways in which a trader can calculate the pivot points. Though the crown of the most popular method goes to the 5-point system. In this method, high, low, closing prices, and two supports, as well as two resistance levels, are considered, making it a 5-point calculation. So I'm going to show you the calculations. You never have to calculate anything. But a standard pivot point level formula is the pivot point price is equal to the high plus the close plus the low divided by 3. High, low, close divided by 3. The first resistance level would be 2 times the pivot point level calculated above minus the low. The first support level would be almost the opposite. 2 times the pivot point level minus the high. The second would be the pivot point level plus the high minus the low. The third level, or the second support level, would be the pivot point minus the high minus the low. Third level would be the high plus 2 times the pivot point minus the low. And the third support level is low minus 2 times the high minus the pivot point. Okay. And what this does is it looks like this on our charts. See where we have the S2, the S3, the S4, the R1, the R2, the R3? Okay, Those are the support and resistance levels calculated by the pivot point calculator, and they're automatically dropped if you're using charting the ones directly from your chart, automatically dropped in your charts. Now you can ignore the green lines, purple lines, the dashed line, because those are my levels of support and resistance, are always on my trading charts. The pivot point levels are these gold lines going across on the chart, and they are calculated based on the time frame we're looking at and then generated forward. So how do we do this? We go to our charts, we locate our indicator selection, we then scroll down to pivot point high and low or pivot point standard. In this case we're using a pivot point standard, and click on it, and it's automatically to drop it based on the setup from that charting system. Okay. We'll always see what that is somewhere on our charts. It'll tell us what the basis of that indicator is. But our charts will allow us to adjust these settings. We just go to where it's listed, click on the adjust button. Now we want to click on and pick out the type of pivot point we want. We'll talk about this in a minute. Classic, traditional, Fibonacci, Woodies, DM, or Camarillas. We also want to decide how many lines we want on our charts. I mean, some people want to have a lot of congestion on your charts. Others, like myself, I just want the R1, the R2, the R3, the S1, the S2, and S3. And you can color code them. You can do whatever you want with them. So as you see, now I've cleaned them up on my charts. My chart's not as hectic. I can see my R1 in purple, my R2 in blue, my R3 in green, but that's it. I don't have any 4s, 5s, and 6s. I see my support in purple, 1, 1, 1, all the way going down. Clean and easy to see. Now, if you want to know where these numbers come from, or you want to develop your own, you can go to what we call a pivot point calculator. And you simply go in there and drop in the high, the low, the close, and the open for the last time frame, and it's going to calculate them all for you and give them to you on a chart. Or most places like investing.com or most Forex sites or whatever you go to already have them calculated. You can go along and see them easy on the line, and you can change from hourly to daily to weekly, and it'll recalculate and give it to you easily to see. They're easy to get. You don't have to do anything to get them, and you don't have to do the calculations. Now, I did mention some funny names. There are multiple types of pivot points for Forex traders, okay, other than the standard pivot points. Now, what are these funny names? We have floor pivot points, also known as standard or classical pivots. These use the specified formula that we talked about and identify support and resistance levels. Fibonacci pivot points use important Fibonacci levels to determine where support and resistance is located. Camarilla pivot points use mathematical formulas to generate potential support and resistance levels. DeMark's pivot points focus on the most recent data to identify potential turning points, and Woody's pivot points are calculated from the past price points. Okay, so Woody's calculation is quite different than the standard formula. Okay, but it uses the same information, but in this case it uses exponential moving averages to calculate things to come up with the pivot point level. And then once you come up with that pivot point level, the same formulas are applied just like you apply them in the traditional. Because Woody's, because they are different formulas, levels obtained through the Woody's calculator are very different than those you have gotten through the standard method. Some traders prefer to use the Woody's formulas because they give more weight to the most recent closing period. Now, Camarilla's pivot points were invented by Nick Scott in the 1980s. They are similar in concept to Woody's in that they use the prior day or prior time frame, closing price, and the range to compute the levels. An interesting part of Camarilla's equation is that a special multiplier is included in the formula. And then Fibonacci pivot points. Fibonacci studies such as retracements, extensions, we all know them, 38.2, 61.8, 100%. Okay. The primary Fibonacci levels are used to incorporate these in pivot point calculations. In fact, it's very similar to the standard pivot points with the additional inclusion of a 38.2, a 61.8, and a 100% ratio. Fibonacci pivot point levels are determined by first calculating the pivot points like you would for the standard method. Next, multiply the previous range with the corresponding Fibonacci level. And then the marks. The marks pivots points were introduced by Tom DeMark, a famous technical analyst and trader. DeMark's pivot points are very different from other types of pivot points is that we have discussed before. These pivot points have a conditional nature based on the relationship between the opening price and the closing price. DeMark uses the number X to compute the upper resistance level and the lower support level. DeMark's pivot points place more emphasis on recent price action. Now, we use these pivot point levels as noted to identify support and resistance levels on a chart. Once calculated, these are then marked on our charts to determine where the market may stop or accelerate its run. Therefore, pivot points are practical and technical tools as they can help us mark the resistance and support levels. In layman's terms, resistance levels indicate where there's a surplus of sellers or vice versa. These two refer to the upper and the lower obstructions that is facing the current price action. Like I say, imagine prices on an elevator and the ceiling is above your head, the floor is below your feet. If the elevator is moving up, you have to break through that ceiling. Okay, what floor is that ceiling you're going to break through? If you're going down, the floor is supporting you, but if you're going down, you have to break through the floor. So the simplest way to use pivot point levels in your trading is just like regular support and resistance levels. If price is nearing a support level, you could potentially buy or put your stop just below that level. So here's an example on a 15-minute chart of the pound. So here, instead of using support and resistance levels that we look from historics, we're using our R1s and S1s and our R2s and our S2s. And we can use this to buy just above our support level, set our target at our current pivot point level, and put our stop loss slightly below our lower support level. Or you could be a little bit more conservative and place your stop loss way, farther below support 2. If the price reaches support 2, chances are it won't be coming back up, as both S1 and S2 could become resistance levels. Now, you could also use pivot points for range trading. You could define a range between your pivot point level and your support level, or your pivot point level and your resistance level, and once you've targeted them, you could range trade between those levels. Most of the time, trading normally takes place between the first support and resistance levels. Occasionally, price will test the second level, and occasionally the third level will be tested. Now, the thing you have to remember is pivot points are calculations based on the most current time frame. Okay. They will change. So just because they're not like eyeballing support and resistance where they're good historically. These pivot point levels have to be constantly updated because as price moves, so do these levels. Now, before you can trade a breakout, you will first need to identify existing points of support and resistance. While there are many tools available for finding these areas, traders may again choose to use previously discussed Camarilla pivot points. When added to the chart, these pivot points will allow traders to spot breakouts using the R4 or the S4 lines now available on their charts. Now, traders can consider a series of options for trading. The easiest way is to trade a breakout is through a use of series of order entries. Entry orders set above resistance will be waiting to buy the market in the event the price moves higher. Conversely, sell orders will be waiting for it to break below the S4. Now, you could use an order that's called an OCO. One cancels the other. So you could set, if one is executed, it cancels the other out. So here you can see a potential breakout range and where you might want to place your orders. But as with any trading strategy, traders should spend as much time planning their exits as they do their entry orders. Using Camarilla's pivots, traders again can develop a series of systematic methodology for exiting the market. Once the stop is found, traders can then set profit points and do the risk-reward calculations. So in other words, you can see on here, we have our pivot point, our R3, our R4, and our take profit level, all based on a potential breakout and using our pivot points. We can also use this for role reversal. The role reversal is a common price pattern that is found on 99.9% of charts you look at. Once you become familiar with this pattern, you will be able to use it to determine the entry and exit points. One of the most interesting phenomena regarding support and resistance levels, when the price of the underlying asset is finally able to break out and go beyond an identified support or resistance level. When this happens, it's not uncommon to see the previous level of support change its role and become a new area of resistance. One of the difficult things about trading breakout trades is picking the spot to place your stop. Unlike range trading, where you are looking for breaks of pivot point support or resistance levels, you are looking for the strongest, fastest moves. Once a level breaks, in theory, that will become the support turn resistance or the resistance turn support. Again, this is called the role reversal. In other words, you're in that elevator and you're traveling up in that elevator and you're pushing through that ceiling going up and up. At some point, somebody pushes the down button, the elevator starts going down. So that floor below you that was supporting you now becomes your resistance because you have to break below it. That point where that makes that flip from the support to the resistance or vice versa, that is the role reversal. It's very rare the price will break past all the pivot point levels unless a big economic event or market surprises happen. So here you can see the elevator moving up and the elevator moving down. You can use it to set your targets, your stop losses, your entry points. So in this example, once you saw price break R1, you would have set your stop just below R1. If you believed the price would continue to rise, you could keep your position and move your stop manually to see if the move would continue. You can also use pivot points to measure market sentiment. There is one other way to incorporate pivot points into your Forex trading, and that's used to gauge market sentiment. What this means is that you can tell whether traders are more inclined to buy or sell a pair. So, as you can see, as price moves up or down between these support and resistance levels of R1 and R2 and R3, we can tell the stamina or the sentiment of the market. Again, here we can easily see that we have bearish sentiment, whereas if it was reversed and pushed back up to S2 again, we might see that bearish sentiment has waned. Now, pivot points work great with things like MACD. The moving average convergence and divergence is a popular trading indicator, and its main use is to gauge the market's strength, direction, and momentum and duration of a trend. We use the same example to demonstrate how to combine pivot points and MACD. In the bottom part, or the next page, you're going to see the separate window for MACD. MACD appears on the bottom part of your chart. So here we see MACD, and we see the price chart above. We see our pivot point levels, and now MACD is based on crossovers. So when we see this crossover and we see price breaking above a resistance level or bouncing off of resistance, it might give us buy and sell signals. We can also combine pivot point trading with RSI divergences. So as we can see, price is moving down overall while the indicator is moving up. And we can see that price is staying above, though, our support 1 here, and then bouncing above, bouncing off of support, the pivot point, and then breaks through the pivot point. Okay, so we have some indication that this downtrend is over. Similarly to the MACD trading strategy, the positive divergence takes place near S1. Hence, we take a long position in the euro US dollar, targeting a move back to the pivot point. We can also use pivot point strategies with candlesticks. Pivot points can be used with any type of chart, but it is more useful with candlestick charts. This allows you to see price action more effectively. So here we're going to take a look at an example at the Australian dollar US dollar. And you can see the pivot points on the chart. Here R1, pivot point, S1. Okay. And we can see the relationship to the candles, the bodies, and the wicks. And we can see how the candle tried to break above the pivot point, then it fell below, but it's staying way above support 1. So by contrast, in the following example, the prices bounced from near the pivot point the daily pivot point on the hourly USD CAD chart, suggesting that buyers may push the price higher. So again, we can see it right here and see the reaction. The use of the S1 and the S2 and the R1 and the R2 pivot points can help traders gauge entries more effectively. Instead of chasing a daily or pursuing a falling market, a dip to the support level at S1 and then a rally to R1 provides a more effective way of trading than trying to buy when the price has hit R1. As ever in trading, it makes sense to find the trend and go with it. But as you can see, price retraces to the daily pivot or the S1 several times, at which point a reverse takes place as buyers enter the market. Okay. So we can see all of this on our charts, and what's happened is as it falls below the bound to the pivot point and bounces off, it should be regaining its momentum to travel back up to the next resistance level. So day traders, short-term traders, online traders, often prefer using pivot analysis over technical indicators for several reasons. They include: 1, high accuracy. A pivot point is considered one of the most accurate indicators in the market. This explains why a majority of day traders like using it to determine trade entry and exit points. 2, it works great in short-term time frames. Unlike other trading tools that use long-term time frames, the pivot point indicator obtains data from a single day, a single candle, a single whatever, and adjust quickly to short-term charts. 3, it's easy to use. The pivot point indicator is an easy-to-use tool that's been incorporated into most trading platforms and most charting systems. So in summary, Forex pivot points is a technical indicator used to determine potential turning points in price action. There are multiple types of Forex pivot points, with the standard method of calculating pivot points being the most popular. Traders often use pivot points to trade range and breakout markets. Pivot points are regarded as a valuable tool to trade different financial instruments, and using MACD or RSI to trade pivot points can be more accurate and more profitable. So thank you very much for joining us, and that's all for today, folks, and we'll see you in another class real soon. Bye now.